All right, welcome to The Explainer. Today we're going to tackle a concept that's a true double-edged sword in finance, margin trading. This is the stuff that can build massive fortunes and, yeah, trigger epic meltdowns.
So what's the connection? Well, the answer is a single, incredibly powerful idea that's been shaking up financial markets for more than 100 years.
So what is it? Put simply, margin trading is just buying stocks or other assets with a mix of your own money and money you borrow from your broker. It's all about leverage, right? It lets you amplify your buying power so you can control a way bigger position than your cash alone would allow. Okay, so let's start with the good part, the promise. Why would any investor even want to do this? What's the big appeal of trading on margin? And here it is. The goal is to amplify your gains, big time. With leverage, even a tiny little positive move in a stock's price can translate into a huge percentage return on the money you actually put in. That's the dream, right? It's about making your money work way, way harder for you. But, of course, with great power comes, well, a really strict set of rules. And if you break them, you trigger something that every trader dreads, the margin call. Okay, let's make this real. Let's walk through an example. Say you want to buy $10,000 worth of a stock, and it's trading at $100 a share. You decide to use a margin account, which means there are some very specific rules about how much of your own cash you have to put up. So there's this rule, it's called Regulation T, and it says you have to put down at least half, 50% of the initial purchase price yourself. That's your skin in the game. So for that $10,000 trade, $5,000 is your cash, and the other $5,000 is a loan from your broker. Simple enough, right? That's what we call the initial margin. But wait, there's more. There's another absolutely crucial number to watch, the maintenance margin. Think of it as a safety net. It's the minimum amount of equity you have to keep in your account. Regulators say it's got to be at least 25%, but your broker can and often will set it higher. If the stock price drops and your equity dips below that line, bam, that's when your broker issues that margin call.
Now, this isn't some vague feeling. There's actually a precise formula that tells you the exact stock price that triggers that call. It's based on the price you bought at, your initial margin percentage, and that maintenance margin percentage. So if we plug in our numbers from the example, $100 stock, 50% down, 25% maintenance, the math tells us exactly where the floor is.
And that number is $66.67. If your $100 stock drops below that price, your equity, your piece of the pie, has officially fallen below that 25% maintenance level. And now you've got a real problem. Your broker's on the phone and they need cash. Now.
Okay, so getting that call, it's not just a numbers problem. It's a massive psychological blow. It's pure stress. And under that kind of pressure, people often panic and do the absolute worst thing possible.
There is this idea in behavioral finance called prospect theory, and it basically says this: we feel the pain of a loss about twice as much as we feel the pleasure of a gain. That fear of losing is so powerful that when our money's on the line, we tend to make, well, really irrational decisions that just make a bad situation even worse.
And this leads to something called the Disposition Effect. It's this weird human tendency to sell our winning stocks way too early, but hold on to our losers for dear life. When you get a margin call on a stock that's tanking, it's a recipe for disaster. We hate to admit we made a mistake, so we just cling to that losing trade praying for a miracle.
So think about what happens. Instead of cutting their losses and selling the stock that caused the margin call in the first place, what do people do? They often sell their best performing stocks to raise the cash. It's a total disaster. You end up killing your winners and you double down on your biggest loser. You're actually making your portfolio more risky, right when you can least afford it. All right, so we've seen how this can wreck an individual's portfolio. But now let's zoom out and see how one person's bad situation can snowball into a massive market-wide problem.
So, here's a question for you. Let's say you get a margin call for $1,600 and your maintenance requirement is 30%. How much stock do you have to sell to cover that call? Now your gut might say, well, $1,600, right? But nope. The math of margin has this absolutely brutal multiplier effect that catches so many people off guard.
The real answer? You'd have to sell over $5,300 worth of stock. Yeah, you heard that right. To fix a $1,600 problem, you're forced to liquidate more than 3 times that amount. That gap is just shocking, and it's where the real danger lies. So why is that? It's something we can call the liquidation multiplier. See, when you sell, only a part of that money is your equity. The rest just goes to pay back the loan from your broker. So you have to sell a ton of stock just to raise a little bit of equity. And here's the kicker. All that forced selling pushes the stock price down even more, which can trigger margin calls for other people who own the stock. And now you've got a vicious, self-feeding cycle. And when that feedback loop gets big enough and fast enough, it stops being one person's problem. It can threaten the entire financial system. Let's look at two incredible examples of when this whole thing just broke. So, back in 2021, there was this family office called Archegos Capital. And they were using these really complex derivatives, swaps, to build up absolutely massive, hidden bets on just a few stocks. Basically, they were able to get all the exposure to a stock without actually owning it. This meant they could fly under the radar, building up over $100 billion in positions, spread across multiple banks, and no single bank knew just how much risk Archegos was really taking.
And then it all went wrong. One of their key stocks took a nosedive. That triggered margin calls so massive that Archegos just couldn't meet them. What happened next was a complete and utter fire sale. The bank started frantically dumping over $30 billion in assets onto the market. The whole house of cards just collapsed, and some of the world's biggest banks ended up with over $10 billion in losses. Just gone.
And look, this isn't just about high-flying speculators. Just a year later, in 2022, a sudden spike in UK government bond yields, think of it as the interest rate on government debt, set off a nearly identical chain reaction. But this time, it wasn't a hedge fund. It was supposedly safe conservative pension funds.
Yeah, you see, these pension funds were using a strategy that involved leverage to manage their risk. But when the market got spooked and bond yields spiked, the value of their holdings plummeted. Suddenly, these pension funds were facing huge margin calls. And to raise cash, what did they have to sell? Their safest assets, the very government bonds that were causing the problem. All that selling just pushed yields even higher, creating this terrifying doom loop. It got so bad the Bank of England had to step in just to stop the entire system from collapsing.
So what's the takeaway here? Margin trading is a permanent part of our markets. It's a tool for efficiency, but it's also a terrifying conductor of contagion. And as we've seen, it doesn't matter if you're a single trader or a massive pension fund. The core danger is exactly the same. That cascade of forced selling that just feeds on itself. And now, as our markets are moving to even faster settlement times, you have to wonder, are we becoming more resilient, or is the next margin-fueled meltdown just going to happen too fast for anyone to stop?